Attention, please. Okay, let us do the last lecture, and then I will give you the exam tips as promised. How are you today, by the way? Good? Good. So today is the last lecture, unfortunately, and I will really miss you. Okay, so today we are going to talk about multinational firms and operations. We are not going to discuss deep details. I'm going to give you just the principles and some of the basic ideas in order to see how some accounts that you may encounter when you analyze financial statements, how some accounts arise or appear there. Okay? Let us introduce some basic concepts and definitions. Presentation currency is the currency in which the company presents or reports its financial statements. So the word presentation is a keyword. Presentation means the currency the firm uses to present or report its financial statements. Normally, this presentation currency is the currency of the country in which the firm operates or located. Functional currency, again, the word functional is a key word. It is the currency in which the company conducts its primary activity. In many cases, or in most cases, the presentation currency and the functional currency would be the same. And the local currency, the local, again, this is a keyword, it is the currency used within the country in which the company operates. Again, in many cases, the three currencies would be the same. A problem may or would arise, or there are two issues that normally arise in practice. The first one is the case when a firm makes transactions with overseas customers or suppliers in a currency different from its functional and presentation or local currency. Okay? For example, assume that you are exporter. Assume that you are exporting iron ore to a Chinese customer. A buyer from China imports iron ore from you here in Australia. So the transaction should be denominated in one of two currencies, either the Chinese yuan or the Aussie dollar, or maybe another currency like the American dollar, for example. Okay? So one side of the transaction, or maybe both in some cases, would be subject to changes or fluctuations in the exchange rate. This problem is called foreign currency transaction exposure. We will discuss it in greater detail shortly. The other problem that normally arises in practice is the translation adjustment. Translation adjustment arises when a firm sets up subsidiaries overseas. Okay? For example, you are an Australian firm and you set up a subsidiary in Japan, in China, in India, in America, for example. In this case, your subsidiary most likely will use the local currency in that country. And that local currency will be different from your currency as the parent company. So by the end of the year, at the end of the year, when you as a parent company when you consolidate the financial statements of your subsidiaries with your own accounts, you need to translate the accounts of your subsidiaries into your local currency to consolidate them together. Okay? The problem is that some accounts are to be translated at the exchange rate prevailing on the balance sheet date, and some accounts should be translated at the historical exchange rate. If this is the case, then the two sides, the assets side and the liabilities side, might not be equal. Assets and on one side and liabilities plus equity, the two sides or the balance sheet might not be in balance when the accounts are translated. And therefore, we need to do a kind of adjustment in order to keep the balance sheet in balance. Okay? We are going to discuss the two problems one by one. Let us start with the first problem, the one we call it foreign currency transaction exposure. So this is a problem number one. Let us see this example. An importer makes purchases denominated in foreign currency with timing difference between the purchase date and the payment date. So this exposure arises only when there is a difference, between the transaction date and the payment date. If there is no difference, then there is no exposure. Okay? Okay, this is an example. A Finnish importer, Finco, makes a credit purchase from Mexico. Credit purchase. If the purchase is denominated in the Mexican pesos, in this case, the Mexican firm doesn't have any exposure, but the Finnish firm, Finco, has an exposure. Why is that? Because Finco is a European company, and its currency, or functional and local and the presentation currency, is the euro. So if the payment is to be, or if the purchases are to be paid in pesos, on another date after the end of the credit term, in this case, the Finnish company is subject to the exchange rate risk. It is the risk here is that the peso may appreciate in value relative to the euro. If this is the case, then Finco will find itself paying more euros to pay the same quantity of the pesos, okay, in order to settle its account. Make sense? Okay. And the opposite is true if we are looking from the perspective of the exporter. The exporter makes sales denominated in foreign currency with timing difference between the sale date and the payment date. Example, Mexican exporter, Mexico, makes credit sales to Finco. If the sales is denominated in euros, in this case, Finco doesn't have any exposure. But Mexico does have an exposure because its currency, its local and functional and presentation currency is the pesos. So if the transaction is to be settled in euros, in this case, Mexico will receive euros on the payment date, and there is a risk here that the euros will depreciate relative to the pesos, or the pesos will appreciate relative to the euro. In this case, when the Mexican firm receives the euros and convert them into pesos, the firm will receive less amount of pesos. Make sense? So we say in this case that Mexico is subject to the foreign currency transaction exposure, or foreign currency risk, simply. Okay? So sometimes we say the firm is subject to exposure to foreign exchange risk, or foreign currency transaction exposure. Okay? So remember again, at the inception, now let us see how to account for these transactions. At the inception of such a transaction, denominated in a foreign currency, usually accountants they record or write down an entry using the current or the spot exchange rate on the date of the transaction. On the date of the transaction. Spot rate means the current rate, the current exchange rate, okay? Okay. Again, if the payment date is the same as the date of the transaction, there is no currency risk. But if the transaction date and the payment date are different, in this case, we have a transaction exposure or foreign currency risk. So remember this word, only arises when the transaction date and the payment date are different. Okay? So foreign currency risk on transactions arises only when there is a difference between the transaction date and the payment date. Let us see how to account for this risk and the gain and loss that may arise. Let us see this example. Finco sells goods to a customer in the UK. We know that Finco is a Finnish firm, for example, and we know that the functional and the local currency is the euro, whereas the UK, they are still using the pound, with payment to be received in a British pound. So the British firm doesn't have an exposure because it will pay in pounds, its local currency. But the Finnish firm has an exposure because it will receive in a currency, it will receive an amount in a currency different from its local and functional and presentation currency. Okay? So there is a risk here that the value of the pound will depreciate relative to the euro. In this case, we receive less amount of euros, right? Okay. Credit terms allow 45 days for receipt of payment. Finco's functional and presentation currency is the euro. So the exchange rate on the date of the transaction, let us assume that this was the exchange rate on the transaction date, and the exchange rate on the payment date was also higher than the exchange rate on the transaction date. Let us see how to account for any gain or loss. On the transaction date, the Finnish firm will write down the following entry. Debit what? Who can tell? And I will give her or him no lollies. Who can tell? Huh? What is the debit for? Which account will go debit? This is the entry. Debit what? Debit cash, but it is sales on credit. So debit account receivable, 14,600. Credit what? Revenues. Okay, credit revenues, 14,600. Okay. Okay, you remember the principles of accounting and entry recording. Okay. Now on the payment date, the firm will receive the same amount in pounds, 10,000, but the exchange rate at that time is assumed to be higher than the exchange rate on the transaction date. So the value of the receivables, or when the firm converts the pounds into euros, the firm will receive 14,750. So there is an increase. This minus this is 150. So there was a gain to the firm because of the increase in the exchange rate. Make sense? Okay. So the entry the firm here would do is what? I'm not going to ask you in the exam to write down accounting entries, but I expect you to be able to calculate the gain and the loss. Okay? You are expected to do that. But the accounting entries are just for your info. In this case, the debit is to whom? Which account? Cash. How much? 14750, right? Credit to whom? Account receivable, how much? 14600. And what else? Credit also to FX gain, 150. So foreign currency gain, 150. Okay, beautiful. Yeah, good. Okay. So this calculation is very simple and easy, right? Now let us see how to account or calculate the gain and the profit if there was an intervening balance sheet date between the transaction date and the payment date. Okay? So Finco, again the same example, Finco sells goods to a customer in the UK for £10,000 with payment to be received in British pounds. Credit terms allow 45 days for receipt of payment. So this is the transaction date, exchange rate, and this is the exchange rate on the payment date. Assume that the transaction date was in November, year 1. The payment date was in January, year 2. And the company has a December year end. So we have 3 dates now. This is the transaction date. And this is the payment date. And in between, there was the balance sheet date. You know, on this date, on the balance sheet date, the firm has to write down or prepare its financial statements. So assume that the exchange rate on December 31st was year 1 was 1.48. The question is, what is Finco's foreign currency gain or loss for year 1 and for year 2? In other words, what happens when there is an intervening balance sheet date? Okay? Very simple. For year 1, we follow the former example. So this is the value of the receivables on the transaction date based on this exchange rate. On the balance sheet date, the exchange rate is so and so, and this is the value of the receivables, and therefore this receivable relative to this one, it means that the difference, this minus this, is the gain in year 1. So there was a gain of 200 in year 1. Make sense? Okay, beautiful. Later on, in year 2, in the payment date, the exchange rate was this, and the value of the receivables was this. Now, we need to compare this value relative to the balance sheet value, not this one, this relative to this one. So this minus this gives us 50. So there was a loss. We have negative difference. This minus this is negative 50. So there was a loss of 50 euros. Okay? So in year 1, there was a gain of 200. In year 2, there was a loss of 50. The sum gives us a net gain of 150, similar to the original situation. Okay? So combined together, the gain here and the loss here should give us the same answer we would obtain if we take the difference between the exchange rate here and the transaction date. Okay? But accounting for each is different. Okay? Again, on the balance sheet date here, we take the difference between the exchange rate here and the original exchange rate to calculate the gain or loss for year 1. Later on the payment date in year 2, we take the difference between the exchange rate at that time and the exchange rate on the balance sheet date. Okay? Okay. Okay, in summary, if you are exporting or may export sales to overseas, a major asset account will be affected. In this case, your account receivable will be affected. If the foreign currency strengthens relative to your local currency, assuming that the transaction is made in the foreign currency, assuming that you export, for example, in Japanese yens, you are expecting to receive Japanese yens. In this case, if the foreign currency strengthens relative to your local currency, in this case, you gain money. And if the foreign currency weakens, in this case, you lose money. Make sense? And the opposite is true if you import goods from overseas or you make purchases denominated in a foreign currency. In this case, your accounts payable will be affected. And if the foreign currency strengthens, in this case, you lose money because you have to pay more local currency to buy the same quantity of the foreign currency. Make sense? And if the foreign currency weakens, you gain money. So the opposite of this situation. Make sense? Okay. Now, when it comes to reporting, firms have two options. Option 1 is to treat the gains or losses, foreign currency gains or losses, as part of other operating expenses or income. Okay? Other operating expenses or income. Alternatively, firms can choose to report them under non-operating expenses or income. Now, if we have two firms, one of them choose alternative 1 and the other choose alternative 2, and we are comparing the income statement of the two. In this case, the choice between this option and this option doesn't affect the gross profit margin for both firms. But when it comes to the operating profit margin, this one will be higher than this one. Or a firm that reported the gain, we are talking here about assuming that we have a gain. Assume that we have a gain, and the firm, one firm, two firms, they have, let us say, the same quantity of gain. One of them reported the gain here, and the other reported the gain here. In this case, this one would have higher operating profit margin relative to this one. So this one is lower. Make sense? Why is that? Because the gain here is reducing or reduces the operating expenses, which means that the margin will be higher. But the gain here is reported under non-operating, usually under financing. Okay? And that doesn't affect the operating margin. Okay? And when it comes to the net profit margin, there is no difference, or it doesn't make a difference whether the firm reported here or here. Okay? So again, the choice between the two alternatives doesn't make a difference when it comes to the gross profit margin or net profit margin. But it does make a difference when it comes to the operating profit margin. So if you find two firms that report the gain or loss differently, they are not comparable. To compare them, you should reclassify and make sure that the two, they report the gain or the loss similarly. Make sense? Okay? Okay. Okay. We are done with the first issue or problem, the foreign currency transaction exposure. The second issue is the translation adjustment. This is the second problem. Remember that many large firms around the world, they are actually multinational firms, or they have a lot of overseas subsidiaries and operations. Okay? And these overseas subsidiaries usually they have their own financial statements. Usually, most of the time, not always, most of the time, the overseas subsidiaries, they prepare their financial statements in the local currency of the country in which they operate. Okay? If you have a Japanese subsidiary or a subsidiary located in Japan, then this subsidiary most likely will prepare its statements in Japanese yens. The same applies if you have a subsidiary in the US or Canada and Europe. They normally do business and prepare statements in the local currency in which they are located. So as a parent firm located in Australia, when you consolidate the statements of your subsidiaries, overseas subsidiaries, there is a problem called translation adjustment. This problem arises because, as I have said before, some accounts are to be translated using the exchange rate on the balance sheet date, but some accounts should be translated using an average exchange rate, and some accounts are translated using what? Historical exchange rate, as we shall see shortly. How to deal with this issue? We will see some examples very soon. We will see how to deal with this issue, how to do the translation, and where the translation adjustment is reported. Oh, we are half an hour through. I was about to give you a break. Would you like to have a break? No? Keep going? I thought it is around the 3 o'clock. Oh my gosh. Am I moving fast? No? Oh, but we are half of... finished the first half, actually. I didn't expect to finish the first half within half an hour. Okay, I will slow down, or maybe I will go at the same pace. Maybe we finish at maybe around 10 minutes past the 3. Will you be happy to do that? Ah, you like it, okay. I am confident and sure that most of you today came just to pick up the exam tips, right? This is how to attract the bees to the honey, you know. Okay, let us finish the job and talk about the exam tips. So, to deal with the translation issue, there are 2 methods, and the firm has the choice according to IFRS, International Financial Reporting Standards. If you want to become a successful accountant or financial analyst in the future, you should be always aware of the International Financial Reporting Standards, because you will definitely deal with many firms from overseas, or a domestic firm here in Australia, but has also overseas subsidiaries. So you need to be aware of the International Financial Reporting Standards, okay? The first method is the current rate method. As the name implies, the current rate method, it means that we should use the current rate, the current exchange rate. We are talking about the exchange rate, the current exchange rate on the balance sheet date for all assets and liabilities. All assets and liabilities. What about equity? Equity should be translated at historical exchange rate. Historical exchange rate, FX, foreign exchange rate. Okay? Make sense? So all assets and liabilities are to be translated using the current exchange rate on the balance sheet date. Equity to be translated at the historical exchange rate when the account first arises, okay? Okay. The second method is called the temporal method, where we need to make a clear difference between monetary and non-monetary assets and liabilities. Monetary items are cash and receivables or payables that are to be received or paid in a fixed number of currency units. Non-monetary assets include inventory, fixed assets, and intangibles. And non-monetary liabilities include deferred revenues, okay. So when it comes to the monetary items, we use the spot rate on the balance sheet date. Spot rate again means the current exchange rate for all monetary assets and liabilities. For all monetary assets and liabilities, we use the spot rate on the balance sheet date. On top of that, there are some non-monetary assets and liabilities that are sometimes reported at fair value on the balance sheet. If you find non-monetary assets and liabilities that are usually reported at fair value, in this case, again, we use the spot exchange rate to translate them. Okay? So we are talking here about 2 items, monetary and non-monetary, that are usually reported at fair value. both groups should be translated using the exchange rate prevailing on the balance sheet date, okay? Again, just keep them in your memory. Monetary items, assets and liabilities, and non-monetary assets and liabilities that are usually reported at fair value. In this case, we use the current exchange rate prevailing on the balance sheet date. Make sense? Okay. And for the non-monetary assets and liabilities, we use the historical exchange rate. Equity is also at historical. Equity, we translate it using the historical exchange rate. So as you can see, in both methods, method 1 and 2, in all cases, equity is to be translated at the historical exchange rate. Okay? Now, which method is the best for the firm? Well, it depends. When the subsidiary's functional currency is different from the parent's functional currency, the current rate method is recommended. Again, remember, under the current rate method, all assets and liabilities are to be translated at the current exchange rate prevailing on the balance sheet date, the current exchange rate on the balance sheet date. And equity accounts are to be translated at the historical exchange rate. Revenues and expenses are to be translated at an average exchange rate, which is like an approximate exchange rate on the transaction date. Okay? So on the transaction date, we see the average exchange rate and use it to translate the revenues and expenses. Okay? And when the subsidiary's functional currency is the same as the parent's functional currency, in this case, the temporal method is recommended. The temporal method, again, monetary assets and liabilities, we translate them at the current exchange rate on the balance sheet date. And when it comes to non-monetary assets and liabilities, we use the historical exchange rate for items that are usually reported at historical cost. So historical cost at historical exchange rate. Historical cost, I'm talking about assets and liabilities that are usually reported at historical cost. If this is the case, we use the historical exchange rate corresponding to the date when these accounts arise. Okay? And if these non-monetary assets and liabilities are reported at current fair value, we use the exchange rate prevailing on the valuation date, which is normally similar to the FX rate on the balance sheet date. Okay? Similar to the FX rate on the balance sheet date. Because firms normally, they calculate the fair value of some of their assets and liabilities when they are about to prepare the balance sheet and the income statement, right? For the purpose of calculating the unrealized gains and also reporting the fair value of the underlying, right? So it will be the same. Again, equity in both methods, this is the easiest one to remember, huh? Equity in both methods should be translated using the historical exchange rate. Revenues and expenses, if these revenues and expenses are not related to non-monetary assets, again, we translate them at the average exchange rate on transaction date. And if they are related to non-monetary assets, in this case, we use historical exchange rate. There is an exception here, which I am about to discuss with you when it comes to dealing with option, with the inventory and the cost of goods sold. Okay, this part the FIFO and LIFO and cost of goods sold. I expect you to understand what's going on, but of course I'm not going to ask you something very complicated in the exam that asks you to do sophisticated calculations. Just understand what's going on here, okay? Okay. So I'm talking about in the exam, there will be no question asking you to do FIFO or LIFO and making the necessary adjustment in foreign currency to local currency or something like that, okay? But you are expected to understand what's going on. Remember that the ending inventory is the inventory that is usually reported on the balance sheet. Remember that ending inventory is equal to beginning inventory plus purchases minus cost of goods sold, okay? And that gives us the ending inventory, right? Make sense? Huh? Okay. Now, if FIFO is used, in this case, ending inventory is assumed to be composed of the most recently acquired items, because face in, face out. So the remaining items in the warehouses, the inventory, they belong to those that were most recently acquired. Make sense? And in this case, we should use a relatively recent exchange rate close to the date on which these items were bought. Make sense? Make sense? Okay. And if LIFO is used, in this case, ending inventory is assumed to be composed of items, old items, and so inventory will be translated at older exchange rate. Again, we use rates that correspond to the time in which these items were acquired. Okay? Okay. And if the average cost is used, in this case we use an average exchange rate, weighted average, okay? Weighted average. For example, let us say that 20% of the inventory was bought in January, another 30% was bought in, for example, February. In this case, these percents are the weights to be used in the calculation of the exchange rate. We take the exchange rate prevailing at that time when some of the inventories were bought in January and others in February. And then we multiply each exchange rate by the weight, okay, to calculate the weighted foreign exchange rate. Make sense? Okay. Similarly, cost of goods sold is translated using the exchange rates that existed when the inventory items assumed to have been sold during the year were acquired. Okay? For example, if the inventory is calculated using FIFO, in this case, inventory is composed of most recently acquired items, but those items sold are the old ones, according to FIFO, right? So we use the old exchange rate in the translation of the cost of goods sold. Make sense? We use old exchange rate. And the opposite is true here. Here we use old exchange rate to translate the inventory, but we use recent exchange rate to translate the cost of goods sold. Make sense? And if this one is used, we use the same stuff here. If we use average cost, we calculate the average weighted average exchange rate, and we apply it here in the calculation of the cost of goods sold. Make sense? Again, I'm not going to ask you something very sophisticated like this. It will be something very simple, as we shall see shortly. So where should the translation adjustment be reported? Well, Under the current rate method, any translation gain or loss, the translation adjustment could be positive, could be negative. And in this case, it is just an unrealized translation gain or loss. Unrealized, it means that it is a gain or loss on paper. We haven't converted the gain or loss into cash. Okay? So, if this is the case, it should be accumulated as a separate component of the parent firm's equity. Sometimes, or most of the time, it will appear as cumulative translation adjustment. This is the account that normally appears on the balance sheet in the equity section of the parent firm. Now, if the parent firm decided to sell off its overseas subsidiary or operations or close down the business, in this case, the gain or the loss becomes realized, and the firm should remove this account from the equity, and any gain or loss should be reported in the income statement. Make sense? Okay. This is the treatment under the current rate method. Under the temporal method, any translation adjustment gain or loss is to be reported in the income statement rather than in the equity of the parent firm. So it will be reported in the parent's net income or income statement, the parent firm's income statement. Make sense? Okay. So this is an example. You will see, or you may see something like this in the final exam. Very lovely example. On December year 1, a Spanish company, or year X1, a Spanish company called Spanco set up a wholly owned firm in the US called Americo. At that time, the exchange rate between the euro and the US dollar was 1-to-1. Okay, so this is the balance sheet in US dollars, and using the exchange rate at that time, this is the balance sheet, the corresponding balance sheet in euro. Because the exchange rate was 1-to-1, we have the same numbers here and here. Okay? Makes sense? Now let us see what happens when there is a change in the exchange rate between the two currencies. Assume that by the end of the first quarter, the exchange rate was 0.8 euros for each one US dollar. So apparently the US dollar became cheaper. Again, for simplicity, we assume that there were no other transactions. The firm didn't do anything, didn't buy or sell anything. Okay? So the original accounts in the US dollar remains intact. Okay? So these are the accounts in the US dollar. Now, according to the new exchange rate at the end of the first quarter, we want to see how the parent firm will translate these accounts into euro according to the new exchange rate and using the two methods, the current rate method and the temporal method. Okay? Let us see how the firm will make the translation according to the current rate method. Remember, according to the current rate method, all assets and liabilities are to be translated at the current exchange rate prevailing on the balance sheet date, except equity. Equity should be translated at historical exchange rate. Okay? So, on the balance sheet date, the exchange rate was 0.8 euro for each one US dollar. So, in this case, we use the current exchange rate on the balance sheet date to translate all assets and liabilities. Equity, we use the historical. H here refers to historical. So we use the historical exchange rate to translate the equity. Okay? So this is the new value of the assets after the change in the exchange rate. This is the value of the liability, notes payable. And this is the value of the equity. We sum them together. This plus this, we have 14,000. And the sum here is 12,000. Remember that the balance sheet should always be in balance, otherwise it is no longer a balance sheet. Yes. So this is the name. The name tells you. The name means that the two sides must be equal to have a balance sheet. Okay? The adjustment is usually made here, in this side, rather than to this side. Okay? Right? Okay? So this one, this side, the assets side, is to be kept intact without any adjustment. We do the adjustment here under the equity side. This is true when we use the current rate method. We make a translation adjustment. This translation adjustment should be added or subtracted from the equity to make the balance sheet in balance. And under the temporal method, it is reported under the income statement, right? But even that effect, the effect of the translation adjustment will ultimately be included in the equity, right? Right? Because normally the net income is allocated between retained earnings and dividends, right? Right? Okay. So it will ultimately affect the equity side. Make sense? Okay. So according to this situation, this side is greater than this side, so we should add a negative number, negative 2,000, and add it to this side in order to make the total in this side equal to the total here. Okay? So we add negative 2,000. This is the translation adjustment according to the current rate method. This is the translation adjustment. Okay? And under the temporal method, again, here we need to be careful. We need to do the adjustment again to the equity section or equity side, or to the other side, the liabilities and equity side. But remember that under the temporal method, we need to make a clear distinction between monetary items and non-monetary items. We said that monetary items are to be translated at the historical exchange rate, and non-monetary items are to be translated at the, monetary items to be translated at the current exchange rate prevailing on the balance sheet date, and non-monetary items are to be translated at the historical. Okay? So cash is a monetary item. Okay? So we translate it at the current exchange rate. Inventory, because the firm didn't sell or buy inventories, the firm didn't purchase additional inventory or make sales, so we use the historical because it has the nature of non-monetary item. Okay? Notes payable, it is a monetary item, so we use the current exchange rate, and equity always to be translated at the historical. Okay? So again, as we can see, we have an imbalance. This side is greater than this side, so we should add to this side additional 400 to make the total, this plus this, equal to this side. Okay, so this is the adjustment, in this case is positive, right? So it is more useful or appealing to the firm to use the temporal method when there is in such a situation. Okay? We have a positive adjustment rather than a negative. So a firm will have a net asset balance sheet exposure. Net asset balance sheet exposure, if assets translated at the current rate are greater in value or in amount than liabilities translated at the current exchange rate, and a firm has a net liability balance sheet exposure if the liabilities translated at the current exchange rate are greater in amount, of course, than the assets translated at the current exchange rate. Of course, if you still remember the importer and the exporter example or the summary table, if here, much similar to that situation, there we said if you are making credit sales and you have an account receivable in foreign currency, if the foreign currency strengthens relative to the local, you have a gain, otherwise you lose. The same applies here. If you have a net asset exposure and the foreign currency strengthens relative to the local currency of the parent firm, in this case we have a positive translation adjustment. Okay? Otherwise, if the foreign currency weakens, we have a negative translation adjustment. The opposite is true if the firm has a net liability exposure. Strengthening in the foreign currency will create a negative translation adjustment. Okay? And if the foreign currency weakens, in this case, the firm will have a positive translation adjustment. Okay? Any problems, any questions so far? No? Everything is clear? Everything is clear? Remember the example we just discussed? You may see something like this in the final exam. A very beautiful example. Okay. Some countries around the world, they have something called hyperinflation. Hyperinflation means that the inflation rate is too high or more, let us say 2 digits inflation, something beyond above 10%, 10% and above. That is called hyperinflation. Sometimes you may see some countries that have very high inflation rates. For example, Turkey, prior to 2000, used to have more than 30 or 40% inflation rate every year. That was too much. Okay? And its currency, the exchange rate between the Turkish lira and the US dollar was very excessive. It was in millions of dollars, millions of Turkish liras. If this is the case, if a firm sets up a subsidiary in a hyperinflation country, in this case, according to the firm under the IFRS should first restate the subsidiary's local currency, financial statements for the local inflation, and then after incorporating the inflation rate in the restated financial statements, after doing that, the firm should use the current exchange rate in the translation. Okay? Under the US GAAP, the firm should use the temporal method. It doesn't matter what the inflation rate is. Okay? So it depends on whether the firm is following the IFRS or the US GAAPs. So let us see an example. Assume a US company established a subsidiary in Turkey on the 1st of January 2000, at which time Turkey was highly inflationary. The US parent sent the subsidiary $1,000 on the 1st of January to buy a piece of land at a cost of 542,700,000 Turkish lira. That is the equivalent of $1,000, imagine. Okay? Okay, assume no other assets or liabilities. What are the annual and cumulative translation gains or losses given the following data? So this is the start. This is the start. This is the end of year 1. This is the end of year 2. This is the end of year 3. And these are the exchange rates over these dates. And these are the annual inflation rates. So this is the inflation rate in year 1. This is the inflation rate in year 2. This is the inflation rate in year 3. So let us see how to do the adjustment according to the two methods, the IFRS and the US GAAP. According to the IFRS, remember, the International Financial Reporting Standards says that the IFRS says that you should restate the statement for the inflation, and after that you translate using the current rate method. Okay? If this is the case, then every year, this is in year one, we should incorporate the inflation. So this is the inflation adjusted value of the land. So it is 542,700,000 times 1.38. So this is the value of the land at the end of the first year. We take the beginning value, we take the beginning of the year value, this is the beginning of the year value, times the inflation rate for that time, for that year, times 1 plus the inflation rate, sorry, times 1 plus the inflation rate. So that gives us the inflation adjusted value. So this is the value. This is the value, 748,926,000. Okay? This is the inflation adjusted value of the land. Make sense? Calculated as the beginning value, the beginning of the year, times the inflation rate, times 1 plus the inflation rate for that time, for that year. Okay? We do the same here. In this year, the value is the beginning of the year value, 748,926,000 times 1.69, and that gives us the inflation adjustment value. Okay? Make sense? So every year we take the value of the land is adjusted as follows: the beginning value, or the value at the end of the former year, times 1 plus the inflation rate for that year. Okay? The next step is to translate at the historical, it is to translate the inflation adjusted value at the, we translate it at the current exchange rate on the balance sheet date. So in this date, in this year, this was the exchange rate at that time. So we divide the inflation adjusted value, we divide this one by this one, and this gives us the value on US dollar. Relative to the initial value, there was a gain of 116, and this is also equivalent or equal to the cumulative gain or loss, because this is the first year. Okay? The annual gain or loss is equal to the cumulative gain or loss. Now in the second year, the value of the land is this. This is the second year, and this was the exchange rate on the balance sheet date. So we divide this one, this is the inflation adjusted value, we divide this one by this one, we get the value in US dollar for the second year. So this divided by this, we get this one. Now this is the value of the land in US dollar for the second year minus the value in the former year. This minus this gives us the loss of 258. This is a loss of 258. The loss of 258 is added to the balance of gain or loss at the end of the former year. So negative 258 plus 116. So this one is equal to negative 258 plus 116. And this one is equal to 858 minus 1116. Okay? Make sense? So we add this loss to the beginning balance of the cumulative gain or loss, and we get the ending balance. So this one plus this one gives you the ending balance of the, or the cumulative balance of gain or losses. Okay? We do the same for the last year. In the last year, this is the inflation adjusted value of the land. calculated as the former value times 1 plus the inflation rate. Make sense? Then we divide the inflation adjusted value by the exchange rate at that time. This divided by this gives you this. Now this one minus this one is the gain or loss. So this value in US dollar relative to last year's value is 242 positive. This is a gain. We add the gain to the balance of the cumulative translation gain or loss. So this one plus this one gives you this one. So this one is equal to 100 is equal to 242 plus negative 142. Okay? And this one is equal to 1100 minus 858. Okay? Make sense? Okay, beautiful. So this is according to the International Financial Reporting Standard. According to the US GAAP, remember here the firm should use the temporal method. According to the temporal method, a piece of land is a non-monetary item and it should always be translated at the historical exchange rate. So there is no annual gain or loss and no cumulative translation gain and loss. Okay? Okay. Normally, a firm should disclose the tax rate of the foreign operations or the country in which its overseas firms operate, its overseas subsidiaries operate, and the effect on the calculation of its own or aggregate consolidated tax rates and so on and so forth. These are just very basic information. But normally, firms are expected to disclose this stuff, the effect of foreign currency translation and also transaction exposure. Okay? Firms can, for example, do natural hedge in the medium to long run by, for example, the hedge is designed to eliminate or reduce the exposure to fluctuations in the foreign exchange rate. One way to do that is to make our purchases in the same currency to those of our sales. Although this sometimes, in many cases, will be very difficult to do. Okay? Very difficult to do. The second option or method is by relocating your business to the place or country in which most of your business or most of the cash flows are coming from. Okay? For example, if you are located in Australia and most of your sales are to customers in China, the question is, what are you doing here? Go and relocate your business to China, for example. In this case, you clear your mind from the headache of following the fluctuations in the exchange rate. You make sales and purchases in the same currency, right? For example. Again, this is also, in many cases, very difficult to do. So firms, they do something else called hedging using the financial derivatives. In the short run, they always do that. And even in the long run, if the firm cannot do these two, if the firm cannot relocate or make the purchases similar to the currency of the purchase, similar to the currency of the sale, if the firm cannot do that, then it has no options but to follow this one, and that is by using the financial derivatives. Are you aware of financial derivatives like options, futures, forward contracts, and swaps? Okay, beautiful. You can use these financial derivatives to look in the sale or purchase price of any currency or any asset. Okay? So you can remove the uncertainty. Okay? Okay. This is an example showing you what BMW does in practice. Just have a look for your info. And this is a summary of what we have discussed. I told you 10 past 3, 10 past 3. Perfect. Didn't I say that? I told you we can finish by around 10 past 3, right? Perfect, huh? Any questions? Any questions? Keen to see the honey? Eat the honey, huh? Any questions before we go to the exam tips? Okay, just for your info, your marks will be released by the end of this week, if not tomorrow, on Friday, okay? The reason we haven't released them until now because some students are still being evaluated in terms of the presentation. So I think today is the last workshop day. So today we will finish the presentation evaluation. Marks will be uploaded tomorrow and released tomorrow night or maybe on a Friday night, okay? Maybe normally I do some audit and double check and make sure that, because there are different tutors for this unit, I normally make sure that all the tutors, they have the same average, so that any problem or any big deviation is moderated, okay? I want to ensure that all the students on average were treated fairly and equally according to all tutors. Make sense? That's why sometimes it takes time to release the marks, not because we want to make you hungry for the marks, okay? Another issue is that I would like to say that most groups, actually most of you did a wonderful job in the assignment. Really, the performance was very nice. I liked what you did, and most of you had shown genuine effort to do the assignment. And for this, I would like to thank you very much. Okay. Please keep an eye on your email, because from time to time I send important announcements, okay? So always check your email to be updated. Ready? Okay, read these warnings before anything else. Again, the tips do not mean that. Oh, you are shooting pictures. Wow. Okay. So the tips do not mean under any circumstances that you should ignore the remaining materials. So you have to read everything, okay? But pay extra attention to the tips that I'm going to give you. And the tips also, I refer to the slide number, not the page number. Okay? So remember that lecture notes on LMS are usually uploaded either using two formats, the PowerPoint formats and the PDF. The PDF formats, usually there are 2 slides in each page. So I am referring to the slide number, not the page number, okay? So here we go. For the MCQ questions, there are 40 MCQ questions. Each is worth half a mark. Each is worth half a mark. The questions are coming from these slides for lecture 1. Lecture 1 from slide 4 to 6. Note, the dash here, I'm talking about the range 4 to 6, which includes number 5. So 4, 5, and 6. 11 to 13, I'm talking about slide number 11, 12, and 13, okay? So these are the slides ranges from which questions from lecture 1 are extracted, okay? Lecture 2, pay attention to these slides, 5 to 7, 10 to 14. Lecture 3, 4 to 6, 14 to 16, and so on and so forth, okay? Pay attention. No one gives such valuable tips. Nevertheless, last year I gave my students similar tips, but unfortunately the performance was below expectation. It doesn't mean that the exam was difficult. The exam, I will tell you something about the exam after the tips. Okay, so there are 40 MCQ questions. Each is worth half a mark. The questions will be a mixture of calculation and non-calculation, okay? The calculation questions are much similar to the RAT test. Same difficulty and same level. If you understand the RAT exams, you should be fine. Okay? So the calculation questions, they have the same structure and level of difficulty like the RAT test. And there are non-calculation questions that are based on your understanding. Okay? There are also 5 problem-solving questions. These are the longer questions. One of them from lecture 6, one of them from lecture 8, one of them from lecture 9, one of them from lecture 11, and one of them from lecture 12. Actually, I already told you what the question looks like for lecture 12. During this lecture, I told you how the question. So pay attention to these slides in lecture 11 and 12 for the question. And when it comes to these lectures, pay attention to the examples discussed during the lecture as well as the workshop questions. If you understand both the examples and the lecture notes and the workshop questions, you should be fine. So I'm not using any questions from the outer space. I don't like aliens. So all my questions are topics discussed and covered during the lectures and the workshop. Okay? No alien questions, okay? The formula sheet also will be uploaded by the end of this week. So by the end of this week, I will upload the formula sheet. I will release for you the marks. And also, I will upload also the exam tips for those whose camera didn't work properly. And also, what else? We have arranged actually consultation sessions for you also to help you before the exam. So there will be 8 consultation hours distributed among the tutors over 4 days prior to the exam. So in case you have any problem, come to us. We are there to help you, okay? So read the materials carefully, review everything, try everything. If you have any problem, come to us. We are there to help you before the exam, okay? I will also send you an email and notification about the consultation timetable. Any other questions? I don't want to release you. I want to retain you as long as possible because I will miss you. I'm joking. Thank you very much. Thank you very much. Thank you very much. I would like to say that I really have enjoyed your company throughout this semester. I wish for you all the best in your final exam, okay? And please forgive me if on any day my performance was below your expectation, okay? All the best in your exams.
just the transaction date and the payment date, right? And it also refers to the balance sheet date. So balance sheet date is that between
that's fine. Yeah. Could you please send me by email what you want and send me also a copy of your transcripts. Okay? I will write down for you the email and the recommendation and send it to you. I want to have a look at your performance on all other units. So send me your transcripts and tell me why you need the recommendation for the studies or work. Okay? I can do it by email and send it to you. Okay?
For the spark creation for a short.
You missed the deadline?
I missed it because closing the presentation.
Why did you miss it? We already opened it for 6 days now.
Yeah, I know. I didn't. There was no announcement on the backlist. I don't usually check the email.
This is they told you at the beginning of the semester. Always check your email. But anyway, you didn't do.
I didn't do the spark.
You will not lose marks. You just lost the opportunity to evaluate the performance or the contribution to your business, but you will not lose any marks.
I won't lose marks.
No. Your mark is based on how much based on the score they'll give to you, not how much you give to them or to yourself. You affect their marks and they affect your marks, but you do not affect your own marks. You understand? So don't worry about it. How many? I told you 40. Five. See you guys. Bye bye. So five problem solving questions and 40 MCQ questions. If you are well prepared, you can finish the exam in 1 hour, 10 minutes. Okay.
Thank you.
Okay. All the best.
I'm not sure what you mean. Like, it's not the page number, the slide number.
Because in LMS,
Yeah, there are PPT and PDF.
yeah, in the PDF there are 2 slides for each page.
Yeah.
So refer to the slide number, not to the page. When I say slide number 2, so go to the second slide on the same page, on the page 1. Okay.
Yeah. And do you mean like for us to more focus on the workshop questions or your?
Read everything. My lecture notes, workshop questions, you should be fine. Okay?
So it's like the exam will be similar question type to the.
Exam, the MCQ will be similar to the RATs and the RAT test, and the problem solving will be similar to the workshop questions. All the best. Okay?
Yeah. Cool. So it will not be like huge questions like your lecture exam. Yes.